they're going to be doing a 0%, a zero down, zero credit check, no down payment, take care of all closing costs. And so is this gonna tank the market? Is this gonna put us at a place where we go back to 2008? You know, 2008, one of the big things with 2008 that got us to where we were at was the fact that people were doing subprime mortgages, which means that subprime mortgages means that people between the 640 to the 690 credit score range, which is D credit, were able to get financed on mortgages. So less than perfect credit, you still get a mortgage, and you could leverage up to 110% of your home back then through the means of home equity lines of credit. So what's the difference between what's happening now? Well, before you get all ruffled about it, I want to talk to you guys about the opportunities that exist and the reality of what's happening, because I know that a lot of people right now, they're alarmed by what's happening with the banks, and rightfully so. You should be, because the mainstream media is making this out to be a crazy upset in the real estate market. Now, there's good news and there's bad news to that. The good news is that people are really unaware of what's really happening. The good news is that you can take advantage of what's really happening in the market. So I'm going to give you guys some real stats, and I'm going to tell you guys a little bit more about this zero down and so it's zero down payment and no closing fees the Bank of America is proposing. Now, it's not in every city across the United States. If you're in Los Angeles, you're gonna be one of the test markets. If you're in Detroit, you're gonna be one of the test markets. If you're in Charlotte, North Carolina, you're gonna be in one of the test markets. If you're in Dallas, Texas, you're also gonna be one of the test markets, okay? Those are the 5 test markets that Bank of America is gonna try this zero down payment, no money down, and no closing costs. Now, here's the kicker. It's only for minority home buyers. So who are minorities is my question, because they did a racial profile saying white, Hispanic, and black. That's it, those 3. That's all it's in the article. White, Hispanic, and black, saying that white Americans, 71% of white Americans are in a single family home. 51% of Hispanic Americans are in a single family home, and only 43% of black Americans are in a single family home. Well, if you guys have ever heard the real statistics, 2 times the amount of black Americans get denied on mortgages with their applications that fit the exact same mold as white Americans. I don't know. You know, you guys tell me. I try to be non-discriminatory, non-partisan. I just give you guys the data, the information, right? So my whole thing is I just want to give you guys make the choice, right? Like, I know what I think, and I'll tell you guys that I'm going to be non-partisan here, but I want to give you guys some real data, real information. Now, is this Bank of America's ploy to capture that market? You know, what's stimulating this? Well, let me give you guys some real data. So for those of you guys that feel that this is 2008 all over again, understand that this past month, we only had a reporting from financial institutions on mortgages that less than 3% of people that have single family mortgages are delinquent currently on their mortgage. Those numbers are super low, guys. They're not historically low, but they're pretty damn close to historical lows. So very few people are even delinquent. Now, you go back to 2008, it was the contrary. Tons of people that were delinquent on their mortgages, super over leveraged, no equity on their home because they had already pulled all that equity out on home equity lines of credit. The banks were allowing people to take 110% or better on their equity loans, and they were withdrawing all their equity. So Americans didn't have no equity in their homes because we saw such an amount of appreciated values in real estate. People have a ton of equity in their homes right now. Now, refinances, they have settled. So in spite of all the equity that people have in their homes, most people were sitting back refinancing their homes to be able to pull that equity so they can go out and buy that Mercedes-Benz. They can go out and buy that Range Rover. They can go out and buy or go on that fancy, expensive vacation trip. And that's where a lot of people were expending capital. Now, listen, those have slowed because interest rates are high, right? So obviously, when interest rates are high, people are like, well, I should have refinanced earlier. According to Fannie Mae, interest rates are projected to go back down in 2023, just FYI. And I kept talking about this. I tell people, the quicker interest rates go up and the quicker it plateaus inflation, the better it is. So I kept telling people, embrace the high interest rates temporarily. Embrace them, because they're not going to stay high. They're going to come back down. And when they come back down, you'll be in a better position because inflation will start to taper, right? That's the goal. So get the interest rates high, control inflation, and then let's get back to work, right? Well, we're always working. And so if you listen to this video and what I'm talking about, you'll continue working as well. So along with only less than 3% of our mortgagees being delinquent, if you guys take a look at foreclosure rates, foreclosures over the month of June are down by 25%, meaning that July and August, we are down by over 25% of the foreclosure rate that we hit in June. June was like an annual high. And if you look at June, we were still 1% lower on foreclosures than we were at the exact same time in 2019. 2019 was the highest foreclosures that we've had until we go back to like the 2008 recession. So what I'm telling you guys is, if you guys look at 2019 and go, 2019 wasn't a bad year. It was actually a pretty damn good year, other than the pandemic, right? But financially, 2019, like for us, it was still a really solid year. And so when you look at that and you look at foreclosures in 2019, think about it if you're a fix and flipper or you're an investor, and you go back to 2019 and you look at your revenue and your fix and flips from 2019, not a bad year, okay? Not too bad, not too shabby. So when you compare it to 2019, we're still less in foreclosures than we were in 2019, even in the worst time, which was June thus far. We're already less than 25% variance in the positive direction, where there's 25% less foreclosures just in the last 60 days. So, so pretty cool. So for those of you guys that think the market's really falling apart right now, wait a minute. Now, I will tell you this with what's happening with Bank of America. People are sitting back going, well, they're going to be giving people are going to walk in with no equity in their homes. They're not going to have no money out. The P&I insurance is going to be protected. So we're looking at this going, is this going to stimulate? Is this going to stimulate things to put us back to where 2008 was? It could. So here's what's cool. Now, these banking parameters the Bank of America is proposing are out to 2027. Okay, so if this works, they're proposing this out to 2027. Here's what's cool, is that it may affect us. I'll tell you, it might. I don't know yet, because we don't know. We haven't seen this all unfold, right? But anytime you give people subprime mortgages, because they're not going to look at the minorities credit, it's going to be credit exempt, so they're not looking at low credit rates. They will finance you if you have low credit rates. What they're going to be looking at is they're going to make you provide them. It is below 640 credit score, or in thereabouts, as long as you have good rental history, and as long as you've been paying your utility bills on time, we're going to give you this minority zero down, zero closing cost mortgage. Okay, so they sit back. And my question is this going to be abused, or is it not going to be abused? We don't know yet. So one of the big things that you want to do is you want to take a look at the long haul. And so when we look at this over the course of time, there may be writing on the wall that in 2008, we may be looking at a place in time where other banks, other institutions adapt to what we're talking about right now with Bank of America's test trial with this minority lending with zero down payments, okay? Now, if you take a look at this, just watch the writing on the wall, because when the writing on the wall comes into fruition, we may end up having some opportunity in 2028. Now, right now, if people are crying out 2008 again, I'd be leery to compare what we're going through right now to 2008. Let me tell you guys something right now that's super, super, super important to pay attention to. Look, ladies and gentlemen, here's what's happening to the market right now. The market is cooling, okay? It's not dying, it's cooling. Now, hear me out, because there is such a housing need right now, such a housing need. It's super important that you guys understand this. There is such a housing need right now. There is not enough homes on the market, okay? So people are staying put. Rentals are the desire for rentals are going up. People are not refinancing their house. There's a cooling in the market. So what Redfin is projecting is that housing prices in 2023 are going to plateau, meaning they're not going to go up in value. So look, we had over a 30% appreciated value in homes over the last 2 years, historical. When you compare that to the national average of about 1.5% to 2% annually on appreciated values, that right there alone just evaporated 15 years worth of appreciation. So even if we dropped 15%, let's say we cut that 30% in half and we went down 15% in value, which is also what Redfin is projecting, and the housing prices just plateaued right there. But as long as inflation plateaus at the same time, we're still sitting at a really, really good place. Because what's going to end up happening is anytime there's a leveling in the market, but the market acclimates to what's happened right now in housing prices, the market knows that we can bear those prices. So over the course of time, prices are going to slowly start appreciating up in value along the side of that plateau. There's going to be appreciation that's just coming out of that stretch, and they will go back up and they'll supersede where we are right now today. As God is my witness, you mark my words, I promise you, over the course of the next 5 to 7 years, we're going to see values not only go back up to where we saw them at the highest peak, but you're going to see them supersede that. Okay, and I can sit here for the next 30 minutes just telling you story after story after story about how we've seen this happen historically over the course of the last 25 years that we've been in business. But I'm not going to do that. I'm just going to tell you guys, watch what's happening. You're going to see, as God is my witness, that values will go back up. Now, there is a housing crisis bigger than you guys even realize, and there's people that are sitting on the sideline just waiting to buy. And so for those of you guys that think that it's not a good time to buy land, build houses, there's a video that Yahoo News did just yesterday that you guys should go watch. And if you go into Yahoo News and you listen to the audio recording of this news publication that they did regarding the housing market and where we are today on the housing update, you sit back and scratch your head and go, damn, we are really sitting at a really good place. And that's just one reference point of multitudes upon multitudes upon multitudes of reference points. And where Yahoo News got a lot of their data from was both Redfin and the National Association of Realtors. And if you guys have ever listened to any of my stuff, I always tell you guys, do a non-partisan pool as to who you listen to. So if you're listening to CNBC, NBC News, Fox News, ABC, these guys are rating sensitive. So they want to alarm you because they get more ratings. The more they alarm you, the higher their ratings go. If you go into non-partisan, non-biased, non-partisan articles like the National Association of Realtors, they don't care. They make their money off of real estate brokers. That's where they generate their revenue from. So the multiple listings and all that stuff, they don't care about the revenue that they're getting from you guys. It's real data. It's real data, cut and dry, black and white, real data. And so when you look at that data and that stuff is quoted, I sit back and I listen. I go, that is where the market is really going right there. Those are real numbers. Those are real stats. Ladies and gentlemen, 0 down, 0 closing costs, Bank of America in Los Angeles, Dallas, Texas, Detroit, and Charlotte, North Carolina. If you're in those markets, you can go test it out if you're a minority. Ladies and gentlemen, thank you guys for watching. If you like the information, give us a thumbs up. Don't forget to pound and subscribe so you get more information just like this anytime we post housing market updates, buying and building, and we're teaching you guys investment strategies on how we're taking down multifamily developments, acquisitions, and investments. Click below,